Hey there, fellow finance enthusiast. Today, we're diving into a topic that's both intriguing and crucial for anyone looking to secure their financial future. How much do you need to invest to out-earn the average Social Security check with dividends? Now, before we get into the nitty-gritty, let's set the stage. The average retired worker's Social Security check in 2026 is around $2,000 a month, or roughly $24,000 a year. That's the income floor most retirees build on, and it's a useful benchmark for us to work with. So, the question is, how much do you need in a brokerage account to replicate that check with dividend income alone? Now, the math is simple. Income target divided by yield equals capital required. But what changes at each yield tier is the risk you accept and the shape of your income stream over the next 20 years. Let's break it down. First up, we've got the conservative tier, which ranges from a 3% to 4% yield. At a 3.5% yield, replacing $24,000 requires roughly $685,000 in capital. This is the range for broad dividend growth ETFs and blue-chip dividend kings. Now, three anchors here are Johnson & Johnson, which yields around 2% with 64 consecutive years of raises and a forward annual payout of $5.36 per share. Procter & Gamble yields about 2.9% after its most recent quarterly bump to $1.0885 per share, backed by 70 consecutive years of dividend increases. Coca-Cola pays 53 cents quarterly for a yield near 2.4%. Broad dividend ETFs stretch the yield higher without concentrating single-name risk. The trade-off is capital intensity. You need the most money upfront. In exchange, you get a rising income stream and principal that tends to appreciate. Next up, we've got the moderate tier, which ranges from a 5% to 7% yield. At 6%, the capital required drops to $400,000. This is the zone of covered call equity ETFs, preferred shares, REITs, and select high-dividend equity funds. SBA Communications, a tower REIT, illustrates the compromise. It yields around 2.7% at today's price of roughly $184, but its dividend has climbed from 98 cents quarterly in 2024 to $1.25 in 2026. Covered call funds push distributions into the 7% to 9% range by selling upside. Preferred share ETFs and mortgage REITs cluster nearby. Growth slows in this tier. Covered call strategies cap gains when markets rally, and many high-yield REITs pay from operating cash flow rather than compounding retained earnings. Finally, we've got the aggressive tier, which ranges from an 8% to 12% yield. At 10%, the capital drops to $240,000. This is the tier of business development companies, leveraged covered call funds, mortgage REITs, and high-yield bond funds. Distributions in this range often include return of capital, meaning your principal slowly erodes. Many of these funds have traded sideways or lower over 5 and 10 years even while paying double-digit yields. You are converting your asset into income, not earning income on a growing asset. Now, why lower yields often win? Coca-Cola paid 44 cents per quarter in 2022 and 53 cents in 2026. Johnson & Johnson raised its dividend from $1.06 to $1.34 quarterly over roughly the same span. A 3.5% starting yield that grows 8% annually doubles your income in about 9 years. A flat 10% yield stays flat, and if the underlying fund's NAV drifts down, that flat check buys less every year. For context, the 10-year Treasury yields about 4.6%, meaning risk-free bonds would cover the $24,000 target with roughly $518,000. That's your true benchmark. Any dividend strategy needs to beat that on a risk-adjusted basis. Meanwhile, the national average 12-month CD yields just under 2%, which would require nearly $1.4 million to hit the same income. So, what should you do next? First, pull your Social Security estimate from SSA.gov and subtract it from your actual annual spending. The gap, not the full $78,535 average household expenditure, is what your portfolio actually needs to cover. Second, compare the 10-year total return of a dividend growth ETF like Vanguard Dividend Appreciation at a 0.04% expense ratio. against a double-digit yield covered call fund. The compounding gap is the real story. Third, model the tax hit. Qualified dividends and ordinary REIT distributions land in different brackets, and CD or bond interest can push more of your Social Security check into the taxable zone. The check size at year 1 matters less than the growth rate that carries it through year 20. So, there you have it, folks. That's the breakdown of how much you need to invest to out-earn the average Social Security check with dividends. Remember, the key is to find a balance between yield and risk that aligns with your financial goals and risk tolerance. Thanks for watching, and don't forget to like, comment, and subscribe for more insightful content.